Good morning, good afternoon, good evening, depending where you are on the planet. And welcome to the TGI Friday. Thank God it's Friday, the 7th of October. Trade Day, Bull versus Bear webinar. Steve Miley on the call. Welcome, everyone. Apologies for no webinar yesterday. Super busy, guys, with both markets and trade day, etc., etc. But here we are today. So let's focus on today. Clearly, and I don't want to duck out of having not done a webinar yesterday, but I will go through everything today, but it's clearly massive focus on the employment report, right? So there's not a huge amount to say outside of that. There is stuff to say though, and I will say it. So we'll go through what's been happening, what we've had, what we've got coming up. We'll take a look at the charts as well. Show you some of where I think some of the trigger points might be on the markets that I know you guys are trading. And yeah, then we'll wrap up from there. But yeah, I mean, markets very much focus on this employment report now. So let's have a look. What we've had this morning, nothing huge in here. Although interesting, we did get German industrial production and retail sales both missing expectations. So a sign here at least that the European markets, retail sales, European consumers slowing, okay, worse than expected. A slowdown was expected anyway, bigger than expected, and also industrial production, okay. So showing that both the consumer and production growth data is slowing in Europe. Okay, so potentially the impact from the small, much smaller, far smaller rate hikes that we've seen in Europe in comparison to what we've seen out of the US and in the UK as well. Let's take a look at then. Obviously, it's all going to be about the employment report. There have been signs. So the backdrop of this, I think, the employment report has been growing and growing in importance. I think in the last few months, in that we're really focused on this. We know inflation's high, right? The last 3 to 6 months, or before that, there was a real focus on the increase in inflation. We know inflation is high, and in most places, we know inflation has peaked. It hasn't really started coming down, but we do know that in most parts of the planet, we've seen high inflation, peaking inflation, a drop in inflation or a stabilizing inflation, but it not really coming down. That's going to continue to be a critical focus for markets going forward, clearly, right? Because the fact that we're hiking rates is in reaction to these very high inflation rates. We also will have, as things go forward, we'll get like the kind of the base rate effect of those inflation numbers should naturally come down unless we continue to see prices continue to add another like 5, 6, 7, 8, 9, 10% continue to go up, right? We've had like a shock higher because of rising energy prices, okay? But you could get a base effect where that kind of starts to drop out. But the rate hikes that we've seen across the planet and from the US are starting to have an impact and slow down what is still a relatively strong consumer and a super strong labor market, right? The labor market is still very strong. Jobs still being created in the labor market, but we are seeing signs of all of that slowing down. So I think a much more of a focus now on the employment report than we've seen probably in the last 6 to 9 months, because all the focus has really been on inflation, and we've known that the jobs market stayed strong. So really now looking for that jobs market, and it also almost counterintuitively now, right? What the markets want, what the equity markets want anyway, is they want to see the labor market starting to weaken a little bit, to be not so tight, because then it shows that what the Fed is doing is working. They don't want it to fall off a cliff, right? And then obviously that leads us to the threat of a recession. Okay, they don't want to see jobs, huge unemployment levels and rapidly falling growth numbers. But we do want to see those growth numbers start to come down and start weakening in to this very tight labor market that we have, not only in the US but globally as well, because then that shows that there is an impact coming through from the rate hikes, and then that will then allow the Fed, etc., and other central banks to start to be maybe a little less hawkish, okay, and then step away from that hawkishness. You do actually want to see a slowing, right? And obviously the number we're going for, if we look at the non-farm payroll number, and previously was 315. We are seeing a slowing. The expectation is for an addition of 250,000 jobs, right? But if that comes in lower than expected, almost counterintuitively, that should be, as long as it doesn't fall off a cliff. I mean, if it's down at like 50, that's going to be showing that the labor market is weakening. People are being laid off, and that's not good at all. But as long as it slows, and if it slows more than this, normally a weakening labour market would be a sign of falling growth, and that would be a negative. But I think the market would actually take a low number as positive. So if we for the stock markets. So anyway, 250,000 is the number we have on here coming out of investing.com. And then on the unemployment rate, staying very close to a decades-long low at 3.7%. It isn't the actual low, but I mean it's very close to the low in here. So we'll be certainly watching those pieces of data, and also maybe average hourly earnings to see if we're seeing that to start to drop. The year-on-year number is obviously high because we've got high inflation. If that starts to drop as well, then it shows then that the market is not so tight if average hourly earnings don't go up by as much. So we'll keep an eye on that as well. But all the focus on that jobs report today, and we're just to run through some of the articles in here. So just from yesterday, Wall Street closed, and this was like the really theme from yesterday. I mean, it's not been, Wall Street closes lower. Yes, stock averages were down. They weren't aggressively lower, but the Fed continues to pound this rate hike drum. I mean, that's the story. You get it there on Reuters. We get it here as well. The Fed officials keep hammering hawkish messages on rates because there's concern that there's maybe, after what the RBA, the Reserve Bank of Australia, did earlier this week, they didn't hike rates as much as expected. There's a feeling that maybe there's a pivot. They're calling it the pivot, right? We're calling it the pivot. The Fed pivoting away from being so hawkish and maybe highlighting down the road. And we've already been watching the Fed Watch tool. Down the road, there might be some rate cuts coming, right, in 2023. At the moment, the Fed are telling us no rate cuts in 2023. The market is actually starting to price in maybe at the end of 2023. We are looking for some cuts. But anyway, here you've got Kashkari. Look, quite a ways from pausing rates, okay? So basically he's telling us, right, rates are continuing to go higher, okay? And we've had that across the board from Fed officials over the past few weeks. Waller, Evans, Kashkari here. Remember, Kashkari is a Uber dove, right? And he's still saying, rates need to go higher, rates need to go higher. So we're getting that drum being beaten by the Fed. So 5 things to start your day. Okay, we've already kind of gone through some of this in here. Jobs day today, 255,000 from 315 previously. But we've gone through that. Biden calling out and saying, looking for an off-ramp for Putin. What else do we have in here? Headlines in the UK today about winter power cuts, risk of power cuts in the UK going into the winter. Market's been fairly quiet, and that's it kind of coming from 5 things in here. So again here, look, hawkish Fed may not be deterred by spate of inflation-friendly data. So we are seeing a moderating inflation, but again, they're basically the Fed are telling us, yes, it's moderating, but not enough in here at the moment. Overnight in here, US futures waver, so no real massive move overnight, no surprise ahead of a huge piece of data that markets are marking time. I know most of you guys are watching the equity indices. That's why we have a bigger focus on that, obviously, in the webinars. But just to give you highlights in here of something else going on, the yen in here, dollar yen is pushing back higher. Remember, a couple of weeks ago, the Bank of Japan intervened in markets in here, selling dollars, buying yen to stop dollar yen continuing to climb higher. It's going back up again, okay, close to the level where they intervened last time. Dollar yen, they intervened around the 145 level. When it broke above 145, we're up and have been close to that level in here this morning, nudging up to that 145 level and just above that level in here today. So, and it says in here about, look, holiday looms. Okay, well, they're talking about the US holiday in here. Well, US holiday on Monday is not a real holiday, right? So it's not a markets holiday, Columbus Day on Monday, but it is a Japanese holiday, as far as I'm aware. So, that's going to cause extra issues, okay? Japanese holiday in here, and we've got the payroll number today. So if we get a payroll number that causes the dollar to strengthen further and rally against the yen, you could see. And then given that we are seeing the holiday in Japan on Monday, and if we see dollar yen pushing high, you may see some intervention coming again potentially today if we get a strengthening. And the dollar's not only strong against the yen and has been over the last few days, but strengthening across the board in here. But a slight dip. So a dollar has rebounded the last couple of days, but as a slight dip, a little consolidation dip as we go into the employment report. In the commodity space, oil put, we spoke about OPEC a couple of days ago on the last webinar on Wednesday. OPEC Plus, they did put the production cuts, and it did create a higher oil price in here, and it's set now oil poised for its biggest weekly gain since March. So on the OPEC Plus move in here, so oil continues to nudge higher, and generally across the board in here, we've seen commodities rallying. Gold set for its largest weekly gains since March as well. So we're seeing a push higher in oil prices, push higher in gold prices in here over the past week in here. So yeah, so we're getting this kind of risk on theme that's come back into markets in here. But risk averse investors pile into cash. So this is the bigger. This is your retail guys, right? Investors pile into cash at fastest rate since April 2020. Okay, remember that's the pandemic. Okay, the pandemic broke March/April. When you remember the low though went in not long after that, right? So the low went in I think May, right? So potentially we're getting towards the point, we've been highlighting this. Okay, we had a really bad September. We've seen this decent rebound. Remember, the S&P 500 at the beginning of this week put together its best 2-day winning streak since, when was it? 2009, I think. Might have been 2020, but I think it was 2009. So yeah, market's still trying to recover in here from a very negative September. But again, it's going to be all on payroll today. It really all will be. And just to see though how dire things are, just elsewhere, England and Wales. Okay, so UK company insolvencies highest since 2009, since the financial crisis. And then this was a negative that's been sitting on in Europe as well for Credit Suisse, a huge European investment bank. Has calmed things down by is going to pay down some of its debt, and that's calmed some of the negativity we're seeing coming out from Credit Suisse and the European financial sector over the past week or so because of concerns around Credit Suisse. How are we setting up this morning? Well, we've had a dip lower, kind of mixed in here, but slightly lower for European exchanges, but pretty much marking time in it this morning. You see that the majors in here, the French index, the CAC, the DAX, the German index, and the FTSE in here pretty much unchanged from last night's losses. If we look at the US stocks, about 1% down yesterday, a dip lower. We're kind of unchanged in here. No surprises really that we're quiet. We're kind of consolidating ahead of a huge piece of data. Right, Fed tool, look, this is pushing back higher in here, right? Remember, this got down to nearly 50-50, getting close to like 60-40, it was below 60-40, right? But now pushing back higher because the Fed beating that drum, boom, boom, boom. Hikes are coming, right, in here. So pushing this back higher for a 75 basis point rate hike expected at the next meeting. Right, let's run through some charts. So despite the setback yesterday, we're still inside. This is the S&P. This is the daily chart. It's still inside the previous day's range. Okay, so despite that setback yesterday, still inside yesterday's, and you can see we just held this morning at the range from a couple of days ago. Okay, so if we go and take a look at the 15-minute chart in here, despite this dip, you get a little dip and a rebound. There's the low over here. Okay, these lows, you can see a low here, low here, low here, and the market pretty much just dipped below this low and then bounces. 37.34 was the low there. Over here it was 37.35, and we spiked down this morning in pre-market trading 32.25, and then have rebounded. I don't really see huge value in here. Let me get rid of I don't want to hide them. I want to just remove them. So in here, you're just looking for breakout levels. I just think back below that low, back down through there, it looks negative. Over above these peaks in here, the more recent peaks around 37. You've almost got a 61. If you want to put some 61.30 kind of breakout kind of parameters in here. But be careful, obviously, because you've got different elements to the jobs report. You've got, the algos will flip it one way, as you know, guys. And then you might have revisions to last data. The algos don't always, work that out. The market can fly one way and back the other if we have revisions. If we start drilling into the hourly earnings number, the employment report, the unemployment number compared to the NFP number. So just be careful in here. Don't put these, if you do have trigger levels in, I mean, for those are the obvious ones there and there for me. And if you look at the little counter to it, so we've kind of been sideways for the last few days, right? Okay, we've got decent swings in there, but really sideways. You've had almost a percent swing from highs to lows in here over the last couple of days, but really just consolidating this big up move that we had from the beginning of the week, that big 2-day up move, the biggest up move we've had for some years. So yeah, the market in here poised, no surprising it's poised. It always does go into big data poised, it can make a statement either way in here. For me, the underlying pressures are still to the upside. However, if it's negative, it breaks out these back below these lows. You can easily see this 1 to 2% down. So it's just going with it, really. So breakout parameters there. Let's take a look at the similar story on the Nasdaq. Less negative yesterday, holding way above the Wednesday low. Little dip and a rebound this morning. 15-minute chart, again, just like, I'll be looking, if it breaks the low, you're going short below the low in here. You probably give yourself some room, as I say, maybe this overnight, but probably give yourself room up to this peak in here. So top side, 11.5, where are we? Around 11.560. Not even as high as there. 11.5. Yeah, no, 11.565 basically, and then below the low, really. 11.452 is that? 11.452, yeah. Breakout parameters, of this little consolidation we're seeing. And usually on payroll days, it does, unless you get some kind of mixed data or some big revisions, it tends to just go, right? It tends to just go. So go with, rather than trying to fade. Let's take a look at oil and gold. As we haven't been on for a couple of days. Start off with the daily chart on oil. So up. The pre-rhetoric on the kind of leaked fact that we're going to get these production cuts, and then the continuation of that. We're sitting right up at that peak there and this peak here. So we've got peaks up here at 85.75 and no, that's wrong. Excuse me. 89.63, and 89.99. This morning we've been up to 89.53. So a break of those peaks, opens up upside. Can it go higher? Yeah, you bet it can. Are we overbought? We're getting overbought. You see down here on the RSI, but we're only overbought as we were back here. And what happened here? Well, had a little consolidation, did eventually go higher, and we were far more overbought back up here at the highs. So can it go higher today? Yeah, you bet it can. And those are your trigger points on the upside. 89.63/99 on the top side. Put a 90 handle on this, it could easily add another $2+ on the top side. Let's take a look, and I don't think I even really need to go into the 30-minute chart in here. Look, we're just creeping. So yeah, looking bullish there. Let's take a look at gold daily chart in here. So inside patterns, you can see we had the 2-day up move. Boom, boom, to start alongside that. And remember, we've got the positive correlation now between gold and stocks, or continues to be a positive correlation. And the market has been inside, kind of marking time, inside patterns for the last 2 sessions, and just holding slight dip in here this morning. Again, we're looking at breakout levels for gold. You can draw a more aggressive, let me get rid of all the old lines. You could have some more aggressive lines coming through off the top here. Whoops. Let's just redraw that. Coming off the top here through here. So you could have breakout above there. That's going to be all the way up at something like 1730 though. But certainly below, you can see you've got this confluence of lows here where we have been this morning, here, and then you've got these 2 lower lows. Really below these, it looks more negative, but even below the current low today, it looks more negative. 13.8, but then certainly down through there looks really kind of quite negative. I'm hanging on to a more bullish tone though. So the low there, 1708.8. And you could almost argue, you got a little, if you want to get in this more, it's a line coming across here. So it's just really above the highs though. The more recent highs, you've got a couple there. 22.8 and 23.4. So up through 22, 23. At least going back up to the high there at 1714. If we zoom out to the daily, then this could then it puts this one in play up here, which is 1746.4. You could easily add in, it could be a big day like this, this one here. So high low there was what, $34. We could easily, if we break above here, high there, 1746, could easily be up to 1760, 1770 today. So yeah, I think just run with it. That would be my, that's how I approach markets a day like this. Don't try and be clever, don't try and oppose, and if it does go one way, wait for them and you miss it, wait for the correction, wait for the consolidation, wait for the dip, or dip or the rebound, and then go from there. All right, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day. Helmets and goggles, be at the ready for payroll. And great weekend too. And I'll be back with you with another Bull versus Bear webinar on Wednesday. On Monday. Bye.